to the Q3FY22 earnings call of Muthoot Finance Limited, hosted by ICICI Securities Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anshuman Dev from ICICI Securities. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. It's an honor and privilege to host the Q3FY22 results conference call of Muthoot Finance Limited. From the company, we have Mr. George Alexander Muthoot, managing director.
About 40 to 50% in a typical year does get extended. Okay, I'll ask my second question later.
So now in 23 we have just 10% of expiries. Now, this 10% expiries, as we have said, there's 10 to 15% is a churn we also expect. Now, 23rd, we are expecting a great year going ahead because, at the moment is building up. 23rd is good, a very sweet spot. So now this 10% people, of course, we love to retain our tenants, but, strategically, we also need to capture the mark to market. So 10% expiries in 23 is something we can take as things come, but we are confident that we should be able to, either tenants will continue, or if they do not continue, we'll get very good mark to market. So that's my sense on 23 expiries.
Yeah, got that. And then, the second question was more, just a quick one on operations. In Noida now, given that your effective economic occupancy is 100% for one of the assets N2, does it mean you would prioritize new leases for N1, or how will that, the sort of relative preference between the two assets work?
So now there are two different assets at different set of tenants actually. And tenants have their own set of priorities. There's some tenants who like N2 and there's some tenants who like N1. And this having 100% occupancy really does not matter. The people who want to be in N2, they would like to be in N2. And the people who would like to be in N1, they would like to be in N1. That's something I can say. So that's all I can say here.
Right. You're saying basically the overlap between the interesting two should be quite limited.
I just missed this question. Sorry, please.
I was just clarifying that you expect the overlap in interest to be quite limited between the two assets.
Limited, yes. It will be limited.
Right. Okay. And then finally, a short one, just a data check. What proportion of your current debt is on fixed rate?
Sorry, Kunal, could you just repeat that question because your voice was not clear. Kunal, can you just repeat?
Sure. I was asking what component of your gross debt right now is on fixed rate basis?
Kunal, everything as of today is on the floating one. There is nothing which is on the fixed rate.
Okay, sure. Thank you.
Thank you. The next question is from Sri Karthik from Investec. Please go ahead.
Hi, thank you. A couple of questions. The two deals that you've done in Kensington this quarter, compared to the 97 rupees in place rent, at what price did these two deals happen?
No, so these have happened at business plan rentals and above business plan rentals. I'm not sure I can talk about the numbers right now, but these are, at least one of them is above business plan and one is around business plan, on the business plan.
All right. When you mentioned business plan, these were the potential MTM upsides that were indicated for Kensington, right? Which was close to about 120 odd rupees at the time of filing.
Yes, in one lease we have been able to capture a significant portion of MTM, and one transaction we have not been able to capture a significant portion of MTM.
Understood. That was it. Thank you. The second question is, while you will potentially have some amount of your previous quarter's NDCF available for distributions into Q4, as we get into FY23, it will become a more organic distributions where your NDCF and actual distributions will converge. For that, effectively, you are essentially targeting a 20% top line growth based on which your distributions will be based. Is that a fair assessment of how you envisage things to play out for FY23?
Well, partly that's true on a same-store basis. This is Ankur. But as you always mentioned, this will be a very active REIT in terms of its growth pipeline. And we expect with the strong currency that the REIT units offer to us, that future acquisitions can be accretive to the REIT, not just on a same-store basis, but on a pro forma basis. So our expectations is that the per unit FFO will increase organically, and we will support that even further with new acquisitions.
And on G1, the call option converts to ROFO automatically?
The call option is still valid for another couple of quarters. So, and Brookfield Sponsor Group has the right to extend that should there be a requirement. At this stage, given the strong performance that G1 asset has seen, that asset would be in serious consideration for call option over the coming months.
The validity of 22 August is what you have in terms of timelines there.
We're sitting in February right now, and the asset is fully completed now. As Alok mentioned, the asset saw very strong leasing. So we are probably another, one or two large leases away from this asset being in the stabilized category or the stabilized zone. And we don't see any reason why such asset cannot be considered for exercise of the call option before expiration of the call option date.
Got it. And just extension to one of the earlier participants' question with respect to the fixed and floating components of your current capital structure. As we head into an increasing rate environment, how do you balance the external interest payouts?
So one thing, we have recently reduced the cost of the debt also. And even if the spread, even if the PLR rates gets increased, we can or we may or we will be in the discussions with the bankers also to compensate to some extent. But having said that, the NDCF which we are projecting or the distributions which we are projecting is considering the certain plus minuses of certain percentages on every components of the distribution.
Thank you. I'll come back and see you.
And I would just add that at roughly 30% loan to value, and the percentage change in cost of debt is minute. It's like less than a few percentage points. So the impact on total cash flows for minute increases in cost of debt is not significant right now. In fact, if cost of debt does go up, it will be on the back of strong macro fundamentals, and our leasing and our revenue side will have a much higher positive impact as if there was any small changes in the bank lending rates as well. I would like to believe that we have still further headroom to reduce the spread in our debt with the sponsorship that we offer, and we are very closely working with our lender groups to accomplish that.
Thank you very much. The next question is from the line of Saurabh from JP Morgan Chase & Company. Please go ahead.
Hi, just two questions. One is, if I compare the NOI performance at Brookfield REIT versus some of the other office portfolios, our NOI has been consistently falling over last 2 quarters. So that's markedly weaker than the other REITs which are listed and even some of the other office portfolios. So is that just a market exposure issue, or what do you think will explain that? So that's point one. And the second is, there's a comment made that there is some 20% DPU uplift potential Is that basis the occupancy is reverting to some normalized levels of 92, 93, or what would you think will be a normalized occupancy level for this REIT? Thank you.
I'll take the question and I'll have my colleagues, come in and chime in. So firstly, look, we are comparing, when we say, or your comment about us having lower or lower NOI or, a greater fall in NOI compared to others, we're talking about a very short period of investment comparison between corresponding period of last year and for a couple of quarters. At a committed occupancy of 87%, I don't think we are very far from our peer group. Now, there are two components to NOI. One is the rental and the second is CAM-based profits. Because of lower physical occupancy, CAM-based profits have been lower, which is just a function of occupiers coming back to market. As far as occupancy is concerned, actual leased occupancy, that's the driver of NOI. And I would like to believe that we are heading in the direction where the 87% committed occupancy is not just a leased number, but also a physical occupancy number, which will further bolster our CAM profits, as well as occupancy is heading in the right direction. So the 20% reference to higher DPU potential is when our occupancy, leased occupancy, reaches back the mid-90s level. So I'm not concerned about the low single-digit NOI decline that we have shown in the current quarter. The pro forma numbers look solid based on the current leased numbers itself, and the pipeline remains strong as well.
And sort of when I just add, the decline we've had quarter-over-quarter is more than sort of offset by the new leasing we have done in the last quarter itself. So in a way, we can take this as a signal that we're bottomed out and future holds a lot of growth for us to the tune of in excess of 20-25%.
So, 20-25% NOI growth next year is what you would expect, including the N2. Or would that include your N2 G1 both? Or that's just organic?
So this is just organic, 20-25%, just based on doing the residual leasing left in our portfolio to the extent of, mid to high 90 occupancy.
Okay. So you would expect to move to the mid-90s level by next year, by fiscal 23 itself?
That's correct. We expect to move to mid-90s in 2022. Now, the impact on NOI is always lagging because rentals start after a couple of quarters of leasing. And we're cognizant of that. So whether the timing is this fiscal or next, that remains to be seen. But given the pace of rentals that we are seeing and new tenants coming back to offices, we expect that the 20-25% growth is visible and in the short to near term.
Okay. And this 90s, Ankur, is basically the exit run rate or I'm guessing this is the exit run rate you're talking about?
Sorry, I don't understand exit run rate, but
as in this will be the Q4 number, right? Not the full year average.
Well, so, today as we speak, we are at 87% committed, right? This will inch up to mid-90s. So full year average, yes, you're right. If you average, quarters over the course of the year, it may not be in the mid-90s because of the lower base effect. But once most of the effects of this healthcare pandemic are behind us, on a run rate basis, we should be seen running in the mid-90s. Some parts will probably be in the high 90s as well.
Okay, understood. Thank you.
Thank you. The next question is from the line of Samir Besaiwala from Morgan Stanley. Please go ahead.
Hi, thank you so much, and a very good afternoon to everyone. My questions have been answered, but just a couple of clarifications. So, taking up from the previous one, so when you say 20-25% NOI growth, or is it what does it mean in terms of DPU growth for next year?
That is NOI growth. That is the embedded NOI growth in the portfolio, Samir. So a leverage impact will be higher than that. And as I mentioned to Saurabh,
it will take time for this to reflect in the financials because renters always have a lag effect to actual lease signing.
No, fair enough. So just on a matching timeline basis, does this NOI growth translate into, more or less concomitant growth in DPU?
That's correct. In fact, because of leverage impact, it will actually, DPU growth will be higher than that.
Oh, okay, that's great.
Just for context, our current run rate NOI is slightly shy of 1,000 crores annualized, and the stabilized number is in excess of 1,150 crores.
So I got the NOI at 1,000. What's 1,150 you said?
Our current annualized NOI number is slightly shy of 1,000 crores, and the stabilized number is in excess of 1,150 crores. So that's the uplift you see in NOI, and given that we are about 30% leveraged, the corresponding impact on FFO basis will be higher.
Okay, got it. And the second question is just on the Gurgaon asset, the identified asset G1. It looks like we are not too far from from acquisition based on your commentary. So how should we think about the funding for same? It will be more or less like what we did for the Noida asset, N2 asset, in terms of much more leverage and some equity issuance.
Samir, we are not too far from the asset, from the point at which the asset will be prepared for exercise of the call options, as we did in the case of the N2 tech space asset. We will follow the same protocol. There has to be funding arranged through equity issuances and corresponding debt. We'll go to shareholders for their consent once the board recommends or the independent members of the board recommends. But I believe the Gurgaon asset is much larger, and so it will probably be a larger equity issuance that will be required at that time.
Okay, Uncle. Very clear. Thank you.
Thank you. The next question is from the line of Venkat Samala from Tata Asset Management. Please go ahead.
Hi team. Congrats on good set of leasing. My first question is, if you could help me understand, if I look at the last 2 quarters, the debt has gone up by around 115 crores against a capex of about 34-35 crores. What explains the rest?
So Venkat, if you refer to the NDCF slide, on slide number 26, the net financing on the cash flow basis has come to about 100 crores, and the capex cash outflow, I'm saying the outflow has gone to about 61 crores, and the balance is towards funding the working capital, which is primarily on account of security deposit refunds. If you just see there, we have disclosed the number of LD refund also, which is about 39 crores. So it sums up to, it reconciled with the net financing which we did during the whole.
So basically, this 69 crores is entirely to fund the working capital. Is that right understanding?
No, 99 is the total financing. Out of that, 61 is for the capex and 38 is for working capital.
Okay. Okay. So you are telling for the whole 3 quarters, 3 or 4 quarters.
Yeah, because you need to, or we need to evenly just see that the balancing of the cash flows quarter on quarter and to manage, and then just see on a longer period than a quarter, because quarter working capital management may be little different than for a longer period. On a longer period, the debt should be mainly for the capex only, which is getting reflected even in our statement.
Right. And this 100 crores is largely towards what? This 99 crores?
61 is for capex 38 is for SD refund, working capital.
Okay. Understood. And out of the 224 crores cash that we have, after the payment of distribution and adjusting for working capital, what will we be left with?
The distribution is going to be about 150 crores or 52 crores. The balance is going to remain in the balance sheet for routine working capital because you need to have 1 month's working capital also. That is normally the cash balance you can see in balance sheets of every company.
Right. No, I'm just trying to understand how much disposable cash we would be having. There'll be nothing, is it?
It is about, if you just see on the same slide where I explained you the debt, the distribution is 17 rupees, whereas the cumulative NDCF is 17 rupees 59 paisa. So about 15-18 crore cash is there, which is sitting at the REIT level or the consolidated level, which can be used for distribution, otherwise can be used for working capital also.
Understood. Thanks. And my last question is, if you could break up the 0.36 million square feet of leasing across assets.
Yeah, it's a mix of G2, N1, and Kensington.
In these assets?
50,000 square feet out of this Venkat. And the balance is almost equal between the two assets.
Sorry, 50,000 is in?
250,000 is in G2.
Okay.
Sorry, 300,000.
Okay.
300,000 and the balance is split between the two assets, Kensington and N1.
250,000 in G2 and 50-50 each in the other two, is it?
50% each. So yeah, I mean 250 in G2 and balance new leasing is 50% in each. And
okay. Understood. Thank you. That's it from my side.
Thank you. The next question is from the line of Manish Agarwal from JM Financial Services. Please go ahead.
Yeah, hi. Good evening. So my question would be pertaining to the NDCF walk down. So the net financing activities has gone up on a QOQ basis to 55 crore in this quarter. Why exactly is that happening? We have given a footnote also, but what exactly is the breakup of this 56 crores?
So when I was answering to Venkat, Manish, I mentioned that the financing should be seen over a period of a year or so in place of quarter on quarter, because earlier we had surplus cash in the balance sheet and we were funding the working capital through that, which ideally should have been from the new security deposit or new leasing done. So in this quarter, we have taken the debt to have on a year basis similar number to the capex and as well as the working capital.
Manish, if I may just explain, the use of working capital lines is essentially to not be subject to the monthly or quarterly. There is an ongoing capital program in every asset that is funded through accruals, topped up through debt. Then there is security deposits that tenants pay us. When tenants leave, we return those deposits. When new tenants come, they pay higher deposits. So use of working capital lines in our REIT, unless it's for acquisition when the quantum is much higher, roughly 25%-ish loan to value. Other than that, debt is primarily used for funding the ongoing capital programs at the asset, which is improvement capital as well as some new capital programs, or for short-term working capital, where over a period of time it's a net zero, slightly positive in commercial real estate, if I may say.
Thank you very much. So the line for the participant dropped. As there are no further questions, I now hand the conference to Mr. Ankur Gupta for closing comments.
Thank you, everybody. Really value your support in favor of our company here or the Brookfield India Real Estate Trust. We are very thrilled that the previous quarter, despite the challenges, was a fantastic one. It sets us up beautifully for this current year.
and we'll be back with you to report on the performance of the current quarter in the next one. Thank you very much. Have a lovely day and a great week ahead.
No further time, but unfortunately he's not able to generate. We can't wait any longer. In spite of that, we have kept some of these loan assets as stage 3 asset, which we will liquidate in this current quarter. So
I'm just trying to understand. Is it also linked to the gold price, because that was the quarter when we saw a sharp fall from then on, and since on a year-on-year basis the gold price is lower.
In Q2 there were actually a lot of demand for funds. People are opening up their business, etc., and they wanted funds, and we were there to give them funds for quite easily. And the gold price, the higher gold price at that time also definitely helped. So they borrowed. If they wanted to liquidate it, they would have sold it and got the 100%. But they had expected some cash flow in the coming 3 to 6 months, but which didn't materialize for them. The final option was to auction it.
Right. So in that sense, these auctions will continue going forward also?
It is part of any gold loan business. If the economy is not doing well and these people are not getting the cash flow which they are expecting, if they are mentally expecting, unlike a salaried person who is getting a regular cash flow, 99% of these people are not salaried people. They are all small business and traders, and a lot of things are uncertain, and probably when they don't get the cash flow they expect, finally they abandon the gold, and that is what we auction. We try to give them as much time and accommodate them in our books as maybe stage 2 and stage 3, etc. We try to accommodate as far as possible, and then when it is not possible, then we just auction it.
Right. But is the decision to auction also related to the gold price? I mean, I'm trying to understand.
Auction is not related to gold price, etc. But if suppose the gold price goes up very high, then customers those who thought of abandoning the gold may think of, why should I abandon the gold? I will try to release it and somehow bridge it or take it back. That's the only thing. Other than that, it is not related.
Okay, thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi sir. Just one accounting question. So do we reverse the accrued interest after 90 days past due or immediately on 1 day past due?
No, after 90 days past due.
So then we'll reverse the full 15 months accrued interest, is it? From an accounting perspective? Or just 3 months?
No, 15 months.
Full 50. Okay, got it. And so secondly, just regarding balance sheet liquidity now, we for a while we've been maintaining very high levels of balance sheet liquidity. 20% of our balance sheet is kept in liquid assets. So, and this was not the case earlier, about 2 years back. So do we see a case of trimming liquidity from the balance sheet?
I think we have done this exercise this quarter. I think you would have seen that our absolute finance cost has come down a little bit. That is partly because of some kind of a treasury management which we have done. Liquidity, as we have always mentioned, we have to keep it at a higher level because of the LCR requirements, as well as the challenging times which is there, and also because being an NBFC, we need to have higher liquidity, and it also helps in giving more comfort to the rating agencies. So that we should see it as a part of our business model.
Got it. So the high level is here to stay, simply put.
Not the very high level. A reasonable good liquidity we should expect now. We should be keeping now. If you take it 2 years back, we had all the IL&FS issue, so many NBFC issues, and everything. Every time liquidity for an NBFC, where we don't get any funding or support from the Reserve Bank, we need to have our own liquidity. So keeping liquidity, even at the cost of some interest loss, it's not a bad idea. It's what the board has been always thinking. So we will keep good liquidity, but not necessarily the very high liquidity.
Got it. Okay, so that's all from my end. Thank you and all the best.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thanks for taking my question. Sir, just wanted to understand, gold prices have recovered in the months of November and December and remained broadly flat in January. So, I mean, if I am doing my math right, I understand that there were forward flows of about 1,000 crores in the third quarter in your stage 2 and stage 3. So basically, even if I net off these, auctions that you did about 2,800 crores, there were forward flows of about 1,000 crores in stage 2 and stage 3. So what are the forward flows that you are expecting now, and to that extent, what is the quantum of auctions that it could lead to? That's my first question. It's a related question. I think you and even the other gold financiers always talk about that extra LTV, which is the making charges, which kind of acts as a margin of safety for you. But does that really play out in the real world, given that, I was seeing, if I look at the monthly average gold price of August, when gold prices were at its peak, August 2020, to maybe the monthly average gold price in January 2022, it's broadly around 92% of what the peak gold prices would have been. I'm talking about the monthly averages. So, and despite that, customers still want to abandon their gold. How should we look at this?
So, first of all, can you just tell me what you meant by forward close? I didn't understand this. Forward close.
So, what I meant is, if I look at your stage 2 plus stage 3, which is your 30 plus DPD, as on 2Q and as on 3Q, and kind of take that difference of the 30 plus DPD and then net off this 2,800 crores of auctions that you did, there's still another 1,000 crores which would have probably flown from stage 1 into stage 2 or stage 3.
Okay.
So
I'm asking, sir, looking at the gold prices today, what is the quantum of forward flows that you expect in fourth quarter, and what is the quantum of auctions that it could lead to?
So, we have given the breakup of stage 2 assets and stage 3 assets. Stage 2 asset logically should move to stage 3 assets if it is not liquidated. Stage 3 assets, it's already there as a stage 3, or it has to be either liquidated or it will remain as stage 3. We can't quantify in terms of the auctions because a lot of these customers come and close the loan by paying the amount. As I said earlier, in Q2 of last year, we disbursed 50,000 crores. Out of that, we had to auction only around 2,800 crores and probably another 2,000 crores. So, which means that out of 50,000 crores, only 4,800 crores went as overdue. So, it's a minuscule amount. So, the reason why we have to auction it, you are also mentioning about the making charges. See, why we have lent with this 50,000 at the peak of the gold price. We need to draw comfort from the fact that 45,000 crores got repaid. So that could be either because there is adequate customer is interested in the jewelry. That could be because of also his sentimental attachment. That could also be because of his higher equity in the ornament through making charges, etc. All these factors play a role. Now the reason why it goes for an auction is customer doesn't have the cash flow. What he can do, even if he gives diamond, if he doesn't have the money, what he can do? It will finally go for an auction. So that is the reason why the auctions are happening, because we can't wait any longer for him to generate cash flows and repay this. Ideally, we would like these customers to come and take back the ornament, but we can't wait beyond that period.
Advances were 80,000 crores. Got it, sir. So this is useful. I have just one more question. So given, I understand that you've always kind of said that, the competition doesn't really affect you a lot and kind of visible in the yields and the spreads that you report. But sir, I just wanted to get some comfort that looking at the competitive landscape today and at whatever rates the peers and the competitors are lending, do you have, that comfort that you will be able to maintain your spreads going forward? And sir, the last question that I also had is, you talked about interest income reversals when a loan becomes an NPA, and to that extent, when a loan becomes an NPA, you've also kind of like this quarter increased your ECL provisions. So now, let's say next quarter when you do those auctions and the NPAs come off, would you see a reversal of the interest income that you took during the third quarter?
there will not be a reversal, but the interest income will be higher, and the new loans on which interest is accrued will be higher. There's no need of a reversal. New things will come. Your earlier question was what was the earlier question?
So the competitive landscape and your comfort on the spread.
Competition is always there. We have to survive in competition also. So we have to devise new products. So we will be giving new products. We will come up with something to see that we are able to maintain our yield reasonably well. Our net interest margins or the spread reasonably well. We will try our best to do it. That's it. We will with our what should I say? Our leader advantage, given the gold loan business advantage, many customers should be coming to us. Some go away because of the lower rates offered by some people, but a good part of them should come back to us, and we should be able to reasonably maintain our interest spread.
Great, sir. Thank you so much, and wish you and your team the very best, sir. Thank you so much.
Thank you. The next question is from the line of Digant Haria from GreenEdge Wealth. Please go ahead.
So my questions are, mostly at the industry level. So for any gold loan business which happens at the branches, sir, how important are the employees for, relationship management with the clients? And if I have to just, rate the need of an employee for maintaining relationship with the client, or doing the operations, which is evaluating the gold, and doing the other things which a loan disbursal process would need, where would you rate this relationship? Like, how important is it in the gold loan business generally and for us also?
Okay, that's a very, very nice deduction and things which you have done. I think relationship is important. Probably some competitors feel that relationship is so important that they try to take away our staff, thinking that the relationship will bring all the business. It is not only the relationship, it is also the goodwill and other things of Muthoot which also brings customers. Relationship to some extent helps, but it is not the all in all about it. Just because X moves away from Muthoot to somewhere, it's not that all the customers will move with him. Probably that could be there for some wealth management companies, somebody who is managing the wealth of somebody. If he moves from one company to X company to Y company, they tend to move. But I don't think gold loan people are like that, because most of the people come to Muthoot because of Muthoot's name and Muthoot standards, etc. But a very, very small percentage of thing is there with the relationship. Then your processes, etc. The process and turnaround time is also very important. And because of Muthoot, we have been in this field for quite some time. We have been able to iron out so many other things so that we can do a good turnaround time, a quick turnaround time. Those are all factors which help. So to answer your question, the branch manager or the relationship executive in the branch, not the whole deciding factor for customers to come or not come to.
Right. So you already answered my second question, which I was going to ask, that if the customer if the employee attrition is high, because sir, I generally hear that even a Kotak Bank or an Axis Bank, everybody wants to build a gold loan team, and because we have such trained employees and long-standing employees. Are they asking you for raises, or is employee cost going to meaningfully rise because of the market scenario, or you think we can really manage this whole intense phase?
We wouldn't like to lose good employees. Definitely, we wouldn't like to. And people just don't go away merely because of some salary, etc. But then we have good incentive scheme, so that they are also happy, incentives, rewards, recognitions, etc., which keep them attached to us. But in spite of that, but actually what we have seen is in the recent past, it's not that people are going away from us. We have seen that some people are actually not interested in working. They are thinking that I'll go home and take rest. I'll go to my village, especially in cities, etc. We have seen that people have gone home for COVID, don't want to come back to the city. It's on the lighter side, I'm saying. So there are a lot of people who have just not come back. Anyway, competition, to some extent, there is some churn happens, and some churn also needs to happen always. You can't have somebody sitting there all the way.
Right. So, no, thank you for these answers. Sir, if one more question, if I can ask that, one startup is claiming that, they are taking photograph of the gold ornaments and they're doing some machine learning and artificial intelligence to detect if the gold is pure or not. So, certainly, I think, a lot of people can claim whatever they want, but, you as the largest player, as a leader, as the innovator, are you seeing any such spots in the market which, somebody has cracked well and, which probably we need to learn and adapt, or we are, we are good with the developments which are there? Just any thoughts on this?
We are not at all good with the developments. We are there. We are also thinking. We also have some R&D departments, etc., which constantly evaluate such things. And our Chief General Manager Vijumo, who recently is promoted as Executive Director, he says one day we will see that he wants somebody to put some gold in the vending machine, and the cash should come out from the other side.
Right. Sir, good to hear that. All the best, and yeah.
The load should come out from the other side. So we are also every day thinking of it. But some people sometimes come with some things. But what we have been not able to crack is how to test the gold ornaments without defacing it or without actually cutting it, etc. That is a challenge we have. Probably after some time something may happen, and if there something will happen, we will be the first to do it.
Right, sir. Great. Congratulations, and thank you so much for answering the question.
Thank you. The next question is from the line of Nitesh Jain from Investec. Please go ahead.
Thanks for the opportunity. Firstly, when we auction these
Mr. Jain, sorry to interrupt. Your voice is not clear. So if you can speak closer to the handset, please.
Hello? Is it better now?
Yeah.
Yes, sir.
Yeah. So when we auctioned these loans in quarter, is there any loss that we have booked on principal or interest, or we have been able to recover entire accrued interest as well?
No, we don't have any principal loss. Probably some small interest reduction may be there. That's all. Nothing substantial. There will certainly be some interest loss, but nothing substantial.
Sure. Secondly, I've been noticing that a lot of companies are marketing gold loan at 60 basis point per month interest rates, 70 basis point per month interest rates. And I think in between we are also marketing that. So how we differentiate between customers to whom we will be able to give low interest rates, who will be able to charge high interest rates?
I think it is the branch manager or the people there who decide. Probably we have some schemes also where big loans are there. Regular customer is there who has been with us for a long time. We also have some other loans. That is where we give interest concession. That is the new interest scheme. We have some specific schemes for that, and if you fall in that scheme, we give it.
Okay, and what is the lowest interest rate that they are offering to the customers?
Today it is 6.9%.
6.9%. So
per annum.
And then lastly, the number of new customer acquisition has been flattish or declining for the last many quarters. So are they taking any steps to increase the new customer? So we are able to cross-sell to the existing customer, we are able to activate some of the new customers, but the new customer acquisition number has been flattish or declining on a quarter-on-quarter basis.
This quarter also, our new customers acquisition has actually gone up. It is 3.5 lakhs this quarter. That's the new customers. But unfortunately, many customers in the old loans, etc., they had to be auctioned, and many customers also.
We request all the participants to please stay connected while we reconnect the management. Ladies and gentlemen, we have the line for the management reconnected. Over to you, sir.
Please continue. Your line broke in between.
Yeah. I was asking about new customer acquisition. That number has actually declined Q&Q, and I think YOY also on a YOY basis also this quarter the number is lower than last quarter.
See, overall the outstanding customers would have declined, but then new customer addition had been very high in this quarter. 3.5 lakhs is the new customer addition. But unfortunately, many customers closed their account also. The larger number of customers closed their accounts, and we had to do auctions also. Because of that, the net increase in customers were not there. That is what. But then what we see is what the redeeming factor is that new customer acquisitions are high.
Sure. So lastly, the entire customer acquisition is through branches, right? Are we able to acquire any customer through online channel or any other channel apart from branches?
We have different channels. So online we have lead generations. Not online channels. We have lead generations coming through other channels also. Our repeat customers are there. Our customers who have earlier been there and not coming now, we win back customers. All those things are there. But then the customer has to come to the branch.
Understood. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Manan Tijoriwala from ICICI Prudential AMC. Please go ahead.
Hi, sir. Sir, wanted to understand what would be the quantum of assets that would be about 3 lakh ticket size in our portfolio right now?
About 20%.
20%.
Okay. So basically, just to understand a bit more from the angle that what would be the competitive intensity from the banking circles and other NBFCs, if you could provide some color on that.
Yeah, it is just because it is a higher loan, it doesn't mean that the competitive intensity is high. So we also have lower interest schemes for higher customers, etc. We have different schemes. So competition intensity will be there, but then it is probably our job to see that we retain our customers.
Right, fair enough. And sir, what would be the quantum of assets priced below say 10% rate of interest? So basically the teaser schemes that we had launched everyone has launched in the last quarters.
Okay, I think that is again moving. It's a moving number. What is there this month may not be there next month. So we haven't done some maths on that.
Okay, but if you could provide a range or something.
No, Manan, that information is not available.
Sure, no issues. And sir, what would be the LTV on the stage 3 assets that we hold?
LTV at the time of it will be at the time when we give the loan. Stage 3 can be maybe 3,000. 3,000.
Just 100 rupees above as of today's rate.
100 rupees above today's rate. That's it, correct. That is the maximum.
It will be over 100 on stage 3 assets.
More than what is it today?
What Industry was saying is that that time 12 months back we had given probably at around 3,500 rupees. So 12 months interest got added to it. So it will be somewhere close to 90-95%.
Okay, so it's still up below 100% basically on stage 3 assets also.
See, just because these assets are stage 3 doesn't mean that customer has not paid interest. There are so many loan accounts where customer has paid up-to-date interest. But because these loans have crossed 15 months, it is classified as an NPA. So those cases also will be there.
Correct. Fair enough. That's all from my side. Thank you.
Thank you. The next question is from the line of Sunesh Khanna from IIFL AMC. Please go ahead.
Yeah, hi sir. So sir, given that we have had a flattish quarter this quarter, so are we maintaining a 15% growth target for the year, which I think looks difficult? So in that way, any other target or color you would like to give, will we maintain? We will end the year somewhere around 9% that we have delivered, or it could be slightly higher?
We should be slightly higher than 9%, but anyway, you yourself say that we may not be able to do the 15%. Yeah, it will be a little higher than 9%. Yeah, I don't want to give any number now. Definitely higher.
Okay. And for next year onward, we maintain our guidance of 15%.
Yeah, I think we should be able to do that 15% next year. Yeah.
Got it. That's it from me. Thank you.
Thank you. The next question is from the line of Bunty Chawla from IDBI Capital. Please go ahead.
Yeah, thank you, sir. Thank you for giving me the opportunity. My questions have almost been answered. The one question on the subsidiary part, if I see the Muthoot Money, which is an NBFC, it has reported a huge loss of 9 crores. And if I see there has been an increase in the branches, there has been an increase in the employees, stage 3 assets has gone down, but there has been a reporting of the profitability loss of 9 crores. So any change in that strategy in that NBFC, if you can share that?
I think what is happening is all the loans which are good, especially the commercial vehicles, used commercial vehicles, etc., have become stage 3. And as a prudent measure, we have just written off many of these things, but we expect these to more recovery to come even from the return of accounts. But we just wanted to show a better position with regard to the assets which we have on book. That's why aggressive write-off we did. That is simple as that. Aggressive write-off when we felt that it is beyond the stage 3. That's it. That is why we have taken a loss in the book.
Oh, okay, sir. Thank you. Thank you very much, and best of luck, sir.
Thank you. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So a couple of questions. So one being, if I look at your auctions realization, if I go back and look at the history, so FY21 has been slightly lower than past 2 to 3 years. So is it that the pandemic has been also impacting on the realization front? And how would the picture pan out going ahead? Because now that we have slightly higher numbers.
Can you repeat the question?
The auction realizations, if I look at your FY21 annual report, that number has been lower than your last 2 to 3 years run rate. And now that we have slightly higher number on the auction front, how will the realizations pan out going forward?
How do the?
Realizations, recoveries, realizations through auctions. How will they pan out going forward?
See, realization on auctions depends upon the price at that point of time. On to the first question, past years, the auctions were lower because the collections were better. Now, earlier in the call we had explained the reasons why the auction numbers have went up because of the larger disbursements we have done in Q2 and Q3 of last year. So, and as I said, out of 50,000 crores of disbursement in Q2, the auctions done is only around 2,800 crores, which is a very small number. We could have given some more time, but market expects certain level of certain limits in terms of the stage 3 assets. So we didn't have a choice but to auction these accounts.
Okay. So secondly, so in terms of your gold loan growth, so you were mentioning last quarter that we have also moved out of home turf, looking at newer geographies like North. So how is it like doing business in North on the gold loan side different from what you're doing currently in the existing geography? And will that be a newer trigger to your gold loan traction ahead?
I don't know what. There is nothing like a new strategy for North, etc. North, the only difference in North and South is North, East and West, our branches are in the bigger cities, and in South we are there in smaller towns also. That's the only difference. Otherwise, the same strategy, same growth is what we see in North and South.
Okay. So my last question in terms of provisioning run rate on P&L. So this quarter, last quarter, the provisions have been around in the range of 700-800 odd million. So how do you see this number, a ballpark guidance going forward? You also mentioned that your GNPAs of stage 3 should come down to 2 to 3%. So how will it reflect on the provision on your P&L?
There is actually, practically, if you ask me, there is no need of any provision for a gold loan company because the loan is fully secured. We have the full security with us. but technically we have to provide provisions. So provisions may be, whatever you see, provisions are actually reserves, because we have never had a need to dip into the provisions till now. So we don't need it actually. But then provisions goes up because standard provisioning also goes up, because when the asset goes up, standard provisioning goes up. For the NPA, whatever the provisions we had earlier also, we have never tried to reverse it. But we had excess provisions earlier, we just let it there. So I think we have around 900 to 1,000 crores of provisions in the balance sheet, which if you ask me, it is actually a profit of the company or reserve of the company only, because none of these loans which you see as NPA will result in a loan loss, and we have to write off the provisions or dip into the provisions. And probably next year also, if the stage 3 is higher, we need to do provision more. If the stage 3 is lower, the provision may be lesser.
Okay, sir. I got the fair idea. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to the management for their closing comments.
From my side, Managing Director here, our CFO, Mr. Oman, our new ED, Mr. K.R. Bijiman, and the other new directors who also joined the call. On all their behalf, I thank ICICI and the team who have arranged this, and also definitely thank all the participants for their participation, and also thank them for their support. And we hope and we are sure we will continue to support the company. From our side, we will do our best to run the company well, and for those investors and other stakeholders, we will try our best to give you good returns or good expectations, or we will try to realize your expectations about the company from our side. Thank you and good day.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.